Well, I'd like to deal with the Article 7, which concern business profits. You can see the current version of Article 7 was adopted in the Model Task Convention in 2010. This is the previous version of Article 7. And now you can see an example of Article 7, which is in the convention between the Italian Republic and the People's Republic of China. You could observe that there are several differences. This is another example, the convention between the Italian Republic and the United States of America. This is a third example, the Article 7 in the convention between the Italian Republic and Hong Kong. And this is the fourth and last example, the Article 7 in the convention between the Italian Republic and Romania. Well, Article 7 allocates taxing rights with respect to the business profits of an enterprise of a contracting state, to the extent that these profits are not subject to different rules under other articles of the convention. It incorporates the basic principle that unless an enterprise of a contracting state has a permanent establishment situated in the other state, the business profits of that enterprise may not be taxed by that other state unless these profits fall into special categories of income for which other articles of the convention give taxing rights to that other state. Article 5, which includes the definition of the concept of permanent establishment, is therefore relevant to the determination of whether the business profits of an enterprise of a contracting state may be taxed in the other state. Look, Article 5, which includes the definition of the concept of permanent establishment, is therefore relevant to determination of whether the business profits of an enterprise of a contracting state may be taxed in the other state. Article 5 does not itself allocate taxing rights. When an enterprise of a contracting state carry on business in the other contracting states through a permanent establishment situated therein, it is necessary to determine what, if any, are the profits that the other state may tax. So, Article 7 provides the answer to that question by determining that the other states may tax the profits that are attributable to the permanent establishment. This is the separate and independent enterprise fiction that is mandated by paragraph 2. So, Article 5, Article 7 incorporates three main rules for the allocation of taxing rights on the business profits of enterprises of each contracting state. The first rule: unless an enterprise of a contracting state has a permanent establishment situated in the other states, the business profits of that enterprise may not be taxed by that other state. Therefore, paragraph 1 grants taxing rights to the states in which the permanent establishment is situated only with respect to the profits that are attributable to that permanent establishment. In taxing the profits attributable to a permanent establishment situated on its territory, a contracting state will have to take account of the provision of paragraph 3 of Article 24. That paragraph requires, among other things, that expenses be deductible under the same conditions whether they are incurred for the purposes of a permanent establishment situated in a contracting state or for the purposes of an enterprise of that state. Permanent establishments must be accorded the same rights as residence enterprises to deduct the trading expenses that are, in general, authorized by the taxation law to be deducted from taxable profits. Such deduction should be allowed without any restriction other than those also imposed on resident enterprise, as imposed by paragraph 3 of Article 24 of the OECD Model Tax Convention. The second rule is the following. If an enterprise carries on business in the other state through a permanent establishment situated therein, the profits that are attributable to the permanent establishment, as if it were a separate enterprise, as determined in accordance with the provision of paragraph 2, may be taxed by that other state. The right to tax of the state where the permanent establishment is situated does not extend to profits that the enterprise may derive from the state, but they are not attributable to the permanent establishment. The third rule is the following. Paragraph 4 restricts the application of these rules by providing that Article 7 does not affect the application of other articles of the Convention that provide special rules for certain categories of profits. For instance, profits which derive from the operation of ships and aircraft in international traffic, or for certain categories of income that may also constitute business profits. For example, income derived by an enterprise in respect of personal activity of an entertainer or sport person. Paragraph 2 of the Article 7 applies not only for the purposes of determining the profits that the contracting state in which the permanent establishment is situated may tax in accordance with the last sentences of paragraph 1, but also for the application of Article 23A and 23B by the other contracting states. Where an enterprise of one state carry on business through a permanent establishment situated in the other state, the first mentioned state must either exempt the profits that are attributable to the permanent establishment, sub-article 23A, or give a credit for the tax levied by the other states on these profits, sub-article 23B. Under both these articles, that state must therefore determine the profits attributable to the permanent establishment in order to provide relief from double taxation and is required to follow the provision of paragraph 2 for that purpose. The combination of Article 7, which restricts the taxing rights of the state in which the permanent establishment is situated, and on the other side, 23A and 23B, which oblige the other state to provide relief from double taxation, ensures that there is no unrelieved double taxation of the profits that are properly attributable to the permanent establishment. This result may require that the two states resolve differences based on different interpretation of paragraph 2, and it is important that mechanisms be available to resolve all such differences to the extent necessary to eliminate double taxation. Risk of double taxation will usually be avoided because the taxpayer will determine the profit attributable to the permanent establishment in the same manner in each contracting state and in accordance with the paragraph 2. This is the Article 8 concerning international shipping and air transport. This is the regulation. And this is the Article 9 regulation, which concern associated enterprise. But I'd like to deal with Article 10, which concern dividends. Well, dividends paid by a company which is a resident of a contracting state to a resident of the other contracting state may be taxed in that other state. Then there are a lot of provisions concerned with dividends. By dividends is generally meant the distribution of profits to the shareholders by companies limited by shares, limited partnership with share capital, limited liability companies or other stock companies, which are legal entities with a separate juridical personality distinct from all their shareholders. It is impossible to define dividend fully and exhaustively. Consequently, the definition merely mentions examples which are to be found in the majority of the member countries' laws. Payments regarded as dividends may include not only distribution of profits decided by annual general meetings of shareholders, but also other benefits in money or money's worth, such as bonus shares, bonuses, profits on a liquidation or redemption of shares, and disguised distributions of profits. In the first instance, however, the notion of dividends relates to distribution of profits, the title to which is constituted by shares, that is, holdings in a company limited by shares. The definition assimilates to shares or security issued by companies which carry a right to participate in the company's profits without being debt claims. Stock companies differ from partnerships insofar as the latter do not have juridical personality in most countries, and many states consider that the profits of a business carried on by a partnership are the partner's profits derived from their own exertion. For them, they are business profits. So these states treat the partnership as fiscally transparent, and the partners are ordinarily taxed personally on their share of the partnership capital and partnership profits. The position is different for the shareholder. He isn't a trader and the company's profits are not his, so they cannot be attributed to him. The shareholder is personally taxable only on those profits which are distributed by the company. From the shareholder's standpoint, dividends are income from the capital which they have made available to the company as its shareholders. Paragraph 1 doesn't prescribe the principle of taxation of dividends either exclusively in the state of the beneficiary's residence or exclusively in the state of which the company paying the dividends is a resident. Taxation of dividends exclusively in the state of SUR is not acceptable as a general rule. All the states tax residents in respect of dividends they receive from non-residence companies. For this reason, paragraph 1 states simply that dividends may be taxed in the state of the beneficiary's residence. The term paid has a very wide meaning, since the concept of payments means the fulfillment of the obligation to put funds at the disposal of the shareholder in the manner required by contract or by custom. You have observed that the article 10 deals only with dividends paid by a company which is a resident of a contracting state and doesn't therefore apply to dividends paid by a company which is a resident of a third state. Paragraph 2 reserves a right to tax to the state of source of the dividends. For instance, to the state of which the company paying the dividends is a resident. But this right to tax is limited considerably. Under subparagraph B, the rate of tax is limited to 15%, which appears to be a reasonable maximum figure. A higher rate could hardly be justified since the state of source can already tax the company's profits. On the other hand, a lower rate, 5%, is expressly provided by subparagraph A in respect of dividends paid by subsidiary company to its parent company. Note, before 2017, subparagraph A of paragraph 2 referred to a company other than a partnership, but this exception was deleted in recognition of the fact that if a partnership is treated as a company for tax purposes by the contracting state in which it is established, under the definition in subparagraph B of paragraph 1 of Article 3, so it is appropriate for the other states to grant the benefits of subparagraph A to that partnership. The dividend received by a fiscally transparent entity or arrangement that is treated as the income of a member of that entity or arrangement for purposes of taxation by the state of residence of that member will be considered as a dividend to that member for the purposes of Article 10. OECD G20 base erosion and profit shifting, so-called BEPS project, have addressed a number of abuses related to cases such as the following one. The beneficial owner of the dividends arising in a contracting state is a company resident of the other contracting state. All or part of its capital is held by shareholder residents outside that other state. Its practice is not to distribute its profits in the form of dividends, and it enjoys preferential taxation treatment, private investment company based company. So, Article 29, so-called entitlement to benefits, the drafting of this article will depend on how the contracting states decide to implement their common intention. So, Article 29 addresses the treaty shopping aspects of that case, and states wishing to deny the benefits of Article 10 to dividends that enjoy preferential tax treatment in the state of residence. Well, Article 11 concerns the taxation of interest. The first paragraph says that interest arising in a contracting state and paid to a resident of the other contracting state may be taxed in that other state. Well, this is the regulation. So, interest is generally taken to mean remuneration of money lent, being a remuneration coming within the category of income from movable capital. Unlike dividends, interest does not suffer economic double taxation. That is, it is not taxed both in the hands of the debtor and in the hands of the creditor. Payment of the tax charge on the interest falls on the recipient unless it is provided to the contrary by the contract. Like dividends, interest on bonds or debenture or loans usually attracts tax charge by deduction at the source when the interest is paid. This method is, in fact, commonly used for practical reasons, as the tax charge at the source can constitute an advance of the tax payable by the recipient in respect of his total income or profits. Tax charge by deduction at the source when the interest is paid. What is the economic impact? Case A. The recipient is a resident of the country which practices deduction at the source. So, any double taxation if the recipient is remedied by internal measure. In another case, the recipient is a resident of another country. So, the recipient is liable to be taxed twice on the interest, first by the state of source and then by the state of which he is a resident. Paragraph 1 lays down the principle that interest arising in a contracting state and paid to a resident of the other contracting state may be taxed in the latter. In doing so, it does not stipulate an exclusive right to tax in favor of the state of residence. The term paid has a very wide meaning, since the concept of payment means the fulfillment of the obligation to put funds at the disposal of the creditor in the manner required by contract or by custom. This taxation right will be limited by a ceiling which it cannot exceed. It goes without saying. The contracting states can agree to adopt an even lower rate of taxation in the state of source. Note, Article 11 deals only with interest arising in a contracting state and doesn't therefore apply to interest arising in a third state. Paragraph 2 reserves a right to interest to the state in which the interest arises, but it limits the exercise of that right by determining a ceiling for the tax, which may not exceed 10%. This rate may be considered a reasonable maximum, bearing in mind that the state of source is already entitled to tax profits or income produced on its territory by investment financed out of borrowed capital. The contracting states may agree in bilateral negotiation upon a lower tax or on exclusive taxation in the state of the beneficiary's residence with respect to all interest payments or as regards some specific categories of interest. I think it's enough for this part of my report.